Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Yilmaz over in his usual spot in Dubai. We've got Patricio Alvarez joining us from London. Hope it's not dark yet there, Patricio. And I see at 7:31 Lexington in New York, we've got Fernando, Valle. So I hope everyone had a lovely break, and just want to welcome you back to work life here at the start of the year. And given we've just entered 2024, I think we should start by getting a sense from everyone on the call of what the commodity and energy landscape is going to look like for the year. So at the moment, we're still seeing oil just sub $80 a barrel, at least for Brent. And so, Salih, let's come to you first. When you read the tea leaves for 2024, how do you think about the oil market? What are some of the key indicators that you're watching for the year, and how do you expect 1Q and all the way through the rest of the year to unfold?
Sure. Thanks, Rob, and Happy New Year to everyone. So I'll mention a couple of the things that we're watching, and I think I should start with the geopolitical risk, because we do have mounting geopolitical risks, especially in this region in the Middle East, given the Israel-Hamas war and now the increasing attacks in the Red Sea. But that being said, I mean, you would think that this is a very bullish catalyst. We haven't really seen oil move up that much despite all these rising geopolitical risks. And I think that also speaks for the other side of the equation, where we still have a pretty uncertain and hard to read demand picture. We have Chinese demand still stalling, if you will. And then, of course, we have the OPEC plus cuts, but I think there is some real skepticism by the market on how the compliance will be by the group with these pledged cuts. And beyond OPEC, I mean, what we saw last year was the production in the US, for example, surprised us to the upside. I mean, I think the market was expecting something like 500 to 600,000 barrels per day of an increase. It was closer to about 1 million barrels per day. And outside of that, of course, we had other regions that are non-OPEC that increased its output significantly. I mean, places like Guyana, Brazil. So it seems like this trend may actually extend at least through the first half of this year, where we have a pretty loose oil market balance, I think. I mean, demand is not necessarily that bad, but it's not necessarily that great either. And it seems like we have enough supply to meet that demand. So combining those, I think price volatility can still remain relatively high. In just the last week of trading, we saw oil prices seesawing just because of the headlines that we see, where there's another attack in the Red Sea, but then there's other data from China, and then there's other data from the US about inventory. So I think there will be volatility. But given the market balance will not be as tight as perhaps earlier last year, I think there will be the prices will be rather range bound in the next couple of quarters.
Thank you, Salih. Fernando, I want to come over to you. I don't know if you saw it, but our colleague from Bloomberg Opinion, Javier Blas, had a piece out this morning talking about global oil demand growth. He talked about 1.4 million barrels per day of demand growth, I think, in 2024, and north of a million barrels next year. So we've got that kind of demand picture, maybe, and you could quibble over the numbers, but demand growth is, as Salih characterized, is not that bad, but the market seems to be kind of loose and ignoring the geopolitical factors, as Salih alluded to. So how do you square all of those factors in the oil market for 2024?
I think 1.4 million barrels a day is actually very solid. It's a little bit over the 1.7% that we average on 20 years. So it's actually a really good year of growth if you consider just just crude, not liquids. And no, I guess that I don't square because I do quabble over the number. I think that that is the biggest issue, is how do you get to that 1.4? Do you even get to the 1 million? And the challenge is, and Patricio has been saying this in the natural gas side for a really long time, that higher prices are being met with lower demand. And I think the consumer is telling you, I can't afford $90 oil. I really can't afford $90 oil, and I'm not going to consume as much at $90 oil. And there's nothing OPEC can do about it. There's only something, again, the central banks can do about it, especially the Fed, which is cut rates and say, all right, we'll go back to zero interest rates and inflating the economy, and then $100 oil is back in question. But until then, the consumer is really showing, I can't afford this, and there's really nothing you can do to make me want to consume more, especially reconciling the OPEC's desire for higher prices with higher demand as well.
What is the sweet spot for oil prices given that kind of dynamic? There's a certain level where it gets difficult to get new supply onto the market. So where do we balance if 90 is too high and you get demand destruction at that level? What's the opposite side of the equation?
Well, I think it depends on. It's always a moving ball, right? But I think it depends on the rates. I would say where we are today, it's kind of shown that it's between 70 and 80, maybe 85. I mean, that's every time there is anything else, we revert to the 75 to 85. But the truth is, oil never stays in the sweet spot. It always moves all around it. And the question then becomes, a lot of the consumption has been fomented by government spending, and not just in the US, but obviously OPEC can produce at much lower than 75, 80, $90, that is their floor. They spend too much. So if they cut back on spending, could they do a lot less? Yes. But how does that impact then oil demand if they are cutting back on spending themselves, and that and their break even might fall, but may not fall as fast as oil prices, and that's the challenge that I think OPEC faces.
Salih, I want to bring you back in real quick on just the OPEC dynamics. Where is their mind on this, and are they having difficulty kind of deciding who has to shoulder the cuts? Is it mostly Saudi Arabia, or are other countries really willing to pull back on supply to help, in their view, manage price to the level they want?
I mean, I think they are in a pretty difficult position now, because I think there is a certain expectation by the market that, I mean, if demand continues to be weaker than everyone is expecting, then those preemptive cuts, first, the market expects them to extend them. But then we saw in the last meeting, late November, that when the extension, just the extension is not enough, there's an expectation for them to deepen those cuts, which is what they did, but was also still not enough to support prices above $80 a barrel. And I mean, who shoulders the cuts? I mean, it is always the bigger producers like Saudi Arabia, the UAE, that does a lot of the heavy lifting, especially Saudi Arabia, who is essentially the de facto leader of the group. When it comes to the UAE, I mean, they've been fighting to get a higher base point so that they can actually produce at a higher quota level, which became effective in January. But then I think one small detail, perhaps not that important when you look at it at first, but Angola leaving OPEC may not look that significant, just because, I mean, I don't think they really have that much extra spare capacity anyway. So it doesn't really mean that because they exited, they're going to flood the market with some additional barrels. But it kind of shows that beyond just the bigger producers within the group, I think there may be some tensions brewing about how it may not be feasible for everyone to just keep extending and just keeping these barrels off the market artificially, because I think a lot of member nations are very keen to be producing more. And I mean, I should say these kind of floors that we used to say it's perhaps a $90 a barrel floor that the group is trying to protect. Then it seemed like it was the $80 a barrel floor that they were trying to protect. This essentially is a level that Saudi Arabia is trying to protect, because it does have a relatively high fiscal break-even price, but this is not necessarily the case for the rest of the group. So there are a lot of other member nations in the group that have a much lower fiscal break-even price and that would be happy with a lower price. So I think there are some, and the next full meeting is early June. I'm not saying there will be a dissolution of the agreement or anything like that, but I think there will be some tensions again. And my bold prediction for this year is that we may actually see another small member. I don't think there will be a major producer exiting the group, but one of the small producers, perhaps some of the ones that exited and then re-entered, like Gabon or Congo or Equatorial Guinea. I think I wouldn't be completely surprised if they left the group this year as well.
Okay, Patricio, sorry to keep you waiting in the wings here. So let's pivot, talk a little bit about the gas side of the equation. What kind of dynamics are you seeing, particularly for European gas? Is it a similar story? Is it what does 2024 hold? We've been on a wild roller coaster ride as far as gas concerned. Is the roller coaster going to continue this year?
Yeah, so I don't see that roller coaster continuing into 2024. We've seen lower levels of price volatility, and surprisingly enough, TTF gas prices have actually found some support around 30 euros per megawatt hours. That's where they're averaging at right now, and that's despite the cold spell that we're living in Europe at the moment. And that to us tells us that sort of the trading jitters over supply fears have eased. That's despite the restrictions for the cargo route for LNG and around the Red Sea. That's despite the fact that Russia can cut flows again. And that what that tells us is that this is the market is kind of catching with our expectations for demand as well. Like Fernando was saying. Gas demand in Europe is unlikely, or at least our view is that it's unlikely that European gas demand will increase substantially in 2024. That's mainly a product of stabilizing hydro output levels for power and increasing capacity of renewables, which are carving out at least indirectly a little bit of that demand for gas in power, and also on the industrial side. Industrial gas use remains close to 20% below the long-term norm, mainly and potentially suggesting that at least in Germany, there's a partial deindustrialization of the economy there. So we're obviously taking a close look at a potential rebound in domestic demand, but so far that the only sort of vector for a recovery would be weather related, and as we all know that's a wild card. So all in all, we still think there's more bearish signals for gas prices in 2024 than bullish.
I want to come back on this idea of German deindustrialization. Fascinating concept. And I've seen some of the charts. We're not going to share any here at the moment, but follow up if you want to take a look. Now, is this really a trend that is happening? Are companies relocating manufacturing assets outside of the region? And I kind of want to get a pulse on where Germany and Europe is at on the Russian gas story. I mean, I know that Europe has been all hands on deck trying as much as they can to completely get themselves weaned off of reliance on Russian natural gas. Have they met that goal? Is deindustrialization the result of it?
So yeah, that's a really good point. So to begin with, like the story about companies leaving Germany or just firing up their production capacity outside of Europe, that has been going on. An example is BASF. So yeah, obviously I'm not a chemicals analyst, but just following the news, I know that BASF is basically trying to offshore production outside of Germany. And well, that said, I think it's also important to recognize that electrification is gaining in industry in Germany. So the fall in the PMI, or the production manufacturing index, is not as abrupt as the decline in gas demand, if that makes sense. And in terms of the situation with Russian gas flows, Europe still receives around 26 billion cubic meters of piped Russian gas per year, which represents roughly 5% of 5 to 6% of supply. So it's not massive, and that doesn't flow directly into Germany. It goes mostly to other parts of Eastern Europe. So the other part of the equation is obviously it's Russian LNG, which Europe is still very much consuming. I think there is a risk, or at least there's a push from the European Commission to sanction Russian LNG. That would echo what the US did by sanctioning Arctic LNG, the project that was going to ramp up in Russia as well. So we could see that that story sort of develop throughout the year. But again, just given the fact that demand is so low, it would be a sensible decision perhaps to wean off completely of Russian gas by the end of this year, especially because more LNG supply, or global LNG supply capacity, is expected to come online in 2025 and 26. So we expect the market tightness to ease significantly by the mid-decade.
So I want to come on this idea of sanctions and whether they work. I mean, at the end of the day, oil is a fungible commodity. You can put it any place around the world. And I'm not following the Russian oil story that closely, but my sense is that they're still producing a lot of oil. It's just going to different places. Maybe that's increasingly true in gas because of LNG. So, Fernando, what do you make? Do sanctions actually work on oil or gas? And I also want to get a sense from you, because I think some of your companies are exposed here. Are U.S. companies really gearing up to sort of help on the LNG front, particularly as it pertains to Europe and this question about weaning itself off of Russian gas?
So on the first part, I think on the oil side, it doesn't impact significantly. It does reduce the revenues, but not necessarily on the volume side of the equation. On natural gas, I think it's almost impossible not to affect, because pipelines are costly and long to build, and even LNG terminals are also challenging and difficult to build. So if you do actually shut off, there is an impact because it's harder to move that natural gas. The question is, as Pat was saying, hasn't been totally weaned off because there's the need still to fill that gap. It also creates the potential for cheap domestic energy, but then that's where financial sanctions are supposed to help affect that economy. So overall, it's not as powerful a tool, but it does help. And as far as U.S. companies gearing to help Europe or LNG in general, I think yes, there's certainly a fair amount of capacity that's coming on in the U.S. Exxon, Conoco, Qatargas, among others, that are growing their LNG capacity. A lot of it has to do with also creating a market for their stranded gas in the Permian. As they grow more production, the associated gas there can be negative at times, but they're definitely low margin. And so creating a market for that natural gas is paramount for them to increase their revenues from that part of their portfolio. I think at the end of the day, it's not just overcoming this shortfall of gas in Europe, but when Europe bid up all the LNG in the world in 2022, it led to shortfalls in Pakistan, in India, and in other parts of the world. So there's a huge amount of demand also there that will probably be satisfied here by U.S. LNG and by adding this part of supply. And I'll just mention, I think it's always important to say we're so far from the marginal joule of demand for energy, right? The more energy we bring online, the more consumption there will be, especially if it is affordable. So I think when you take a natural gas that is delivered to the Gulf Coast at under, $1 a cubic foot, if not less, that then gets shipped to different parts of the world, that's a very competitive proposition that can help satisfy some of that demand.
Couldn't agree more, Fernando. One of the really interesting observations I always fall back to is the world spent in excess of $1 trillion on clean energy last year. So that's wind, solar, EVs, these kinds of things. But oil demand's still going up. You can argue about the pace, but it's certainly not bent the curve down. Gas demand still going up. Coal demand, maybe it's flattish, but look, there's still a lot of fundamental demand out there. So Salih, I want to come back over to you and just get a sense from you on, particularly on gas in the region. I know OPEC is a very oil and liquids focused body, but are they looking at gas? Are they worried about the rise of U.S. as a big LNG exporter? Did any of those conversations or discussions affect kind of how they're thinking about the portfolio of both oil and gas?
Not necessarily. I mean, first of all, Qatar has been a huge natural gas and LNG player. It used to be part of OPEC, but isn't anymore. It exited the group also a few years ago. In terms of natural gas, I mean, we do have the national oil companies in the Gulf, like Aramco, like ADNOC, talking about natural gas more and have plans to increase non-associated gas production. But this is not, and they have perhaps, I mean, they are considering LNG as a long-term option. But I think in the beginning, what they're focused on is trying to produce as much natural gas as possible for domestic use, which would allow them to, and it's something that we talked about a few times on this call, which would allow them to export more oil, which is the most lucrative business for them that's available to them. So in terms of that, I don't think they see just yet this as a kind of competition with other LNG producers, that's Qatar or the US, but more as an opportunity for themselves to allow as much oil as possible, additional barrels of crude oil as possible to be exported, which would allow them to get more value out of the resources that they have.
I should add that on the natural gas side, this is not the first time they talked about this. Back in 2013, 2014, when LNG was more expensive than crude, which makes absolutely no sense. They also talked about going into LNG. The main issue is you drill in Saudi and you find oil. They don't find a ton of non-associated gas resources, and so they've always had a challenge with developing natural gas fields to actually quell their crude burn in the summer. They're basically the opposite of in the U.S. and Europe, that they're big crude burning for power is during the summer. As Salih can tell you, it gets pretty hot there, and they need it for all the air conditioning and all the extra energy.
Very interesting. So, Patricio, I think of your companies as kind of an aggregator of all of these trends in some sense. So, the utilities have to contemplate what's the gas price, what's the coal price, even a little bit about where's oil at and what's the role of EVs. So, when you think about a company like Enel or some of your other utility-like names that are under your coverage, what are they gearing up for 2024? What do their capital allocation plans look like?
Sure. I think in short, it would be they're gearing up for a very slow economic growth or a recession, really. All of their expectations for gas prices and power prices are to the downside for 2024 and 2025. That means that the scope to achieve higher power hedges on their generation is diminishing, and it also means that their earnings momentum probably peaked in 2023 when a reversal in supply pressure eased with the easing of gas prices. So so far, yeah, the companies are looking into sort of a choppier 2024 and 2025 in terms of demand. There is a deceleration in the impetus to deploy renewable power capacity, at least on the utilities front. That doesn't mean that smaller scale developers and private developers are not going to keep doing them, but at least for utilities, the landscape has turned a bit too competitive. Rates have made the internal rates of returns for a lot of the projects not very attractive at the moment for utilities, and utilities in that case have the benefit that they can allocate their capital towards networks. So distribution assets, which offer protection from inflation and are not as exposed to fluctuations in demand and power prices. So all in all, utilities are sort of battening down the hatches for a very choppier 2024 and 2025 with less opportunities to capture trading and power generation margin.
Okay, thank you, Patricio. Before we conclude, I just want to highlight that we've got some in-person events coming up. So if you are based in the Middle East generally, particularly in UAE, Fernando is going to be teaming up with Salih for an event in our Dubai office on Monday, January 29th. We've also got an event in Abu Dhabi the following day, and they're also going to be visiting Riyadh. So reach out to any one of us if you want to join for those in-person events. We're also triangulating on an event that's going to take place in our Miami office next month in February. Fernando and I will both be there, plus Mike McGlone, our colleague who's based there, will join us. We don't have a date yet, but we're coming soon with that, so stay tuned. We do these calls weekly, but we are also available in person on occasion, and we'll make sure you've got all the details on that. So just lastly, as a way of closing out, again, I think we've kind of already got the pulse, but we'll just quickly for everyone, what is the top theme or top company that you're looking at for 2024? And so, Salih, we'll come to you first. I do know that several of us here on the call had companies to watch make the Bloomberg 50, so that's available in Business Week. Maybe that's not the answer you're going to give me, but also we'll share that as a follow-up to the conversation here. So, Salih, to you first. Top tier, what's a big theme or company you're watching for this year?
Okay, so I'll repeat on the theme side. We're obviously watching OPEC very closely all the time, but again, my kind of bold prediction about it is that they may actually lose another member this year. So that's on the theme side, and on the company side, I'm watching SABIC very closely, and this was the company that was selected for top 50 companies to watch. I mean, this is the Saudi Arabia's chemicals company. It is the biggest chemicals company in the world by revenue, and they've done a little bit of reshuffling, spinning out their steel unit, and they are very much focused on chemicals now. I think chemicals business is a very much GDP proxy business, which hasn't been so good in the last year, and they've been punished quite heavily alongside the rest of the peer group. But we just wanted to highlight that the company is quite well positioned, given a lot of the advantages it has with access to cheap natural gas and a lot of other benefits of being in Saudi Arabia and a lot of the government support that they get. So looking at this year, I mean, the economic growth may still surprise to the downside, which is not good for the chemicals business in general, but still a gradual recovery in the global economy. I think they're very well positioned for that recovery across the peer group, but especially them after kind of restructuring themselves to be very much focused on chemicals.
Okay, thank you, Salih. Let's move around the world. Patricio, you're up next.
Sure. So, big theme or a relatively big theme will be a potential recovery in European power demand in 2024, or actually looking at how far down can it go really, or the resilience of it, because this is a key indicator for most power utilities in Europe, or for all of them really, as it drives the investment case for renewables and the energy transition investments that drive the earnings growth for the whole sector. Our view is that if power demand continues to decelerate instead of accelerating, utilities could face a revenue cliff a little bit after 2025, just because they won't be able to capture any more upside on the power margin, since prices are going to decline into the end of the decade, making picking up demand or just generating more volumes the only driver for earnings. So we'll be closely following that. And on the company side, we think companies that are focused on renewable capacity development are poised for a recovery in 2024, mainly because we think we've seen the peak of the spike in the levelized cost of electricity in 2023, and also because we are seeing, we potentially will see interest rates stabilize, which will reduce hurdle rates and perhaps drive a recovery in the earnings and the sentiment for renewable focused peers.
Okay, Fernando, over to you.
I guess my big theme is that I'm watching for Salih and Pat to be frustrated, because I think the demand is really poor, and we're not going to get interest rate cuts, and at 5% renewables still don't work, and certainly chemicals is going to be very constrained. So that is my big theme. I think the consumer is stretched. I think Janet Yellen is too hopeful of a soft landing, and we're in for some more pain. But maybe I'm just maybe I'm pessimistic of the group. And then as far as companies to watch, I picked one that made it to Business Week. It's a small company called ExxonMobil. Big thing is that they're acquiring Pioneer. But the big thing really is that I think Darren Woods is finally reaping the benefits of the sea change that he brought on when he took over for Rex Tillerson. Has really reshuffled the company. I think the lazy trade for hedge funds is, long Chevron, short Exxon, because the returns gap was narrowing, and I see that returns gap widening again, primarily because they made good investments. And Chevron has as well. They have a very similar portfolio, but the big difference is Exxon has the best asset in the oil and gas world, which is their LNG projects in Qatar, and they make a significant amount of money, especially now as Pat's companies need more natural gas in Europe and are willing to bid outrageous prices.
So I'm going to close it out, and I'll just say thanks to the IRA in the US and lots of other government support, renewable demand is going to continue to grow at a very fast clip in 2024. We can come back to the economics, have a little arm wrestling match a little later, Fernando, and kind of where all that's at. But I think it's going to be another pretty robust year for both wind and solar demand at the global level. And another company that we got into the Business Week 50 companies to watch is First Solar. At a much smaller scale, I like to think of First Solar as perhaps the Exxon Mobil of U.S. solar module manufacturing. They are essentially kind of the national champion of supports. They're very protected by trade policy, tariffs, and they've got the IRA to boot. And one of the things that's really unique about them is I don't think they care about interest rate policy or what's going on with the economy, because they have sold forward all of the production that they're going to have for not just 2024, but also 2025 and 2026. So they've got a pretty robust backlog to work through in the near term, even if we see demand softening. So let's see how that plays out. Again, we will follow up and share the link for those 50 companies to watch. It's a very interesting read. It's got lots of contributions from colleagues outside of the energy sector as well. And please do reach out to either myself or Patricio or Fernando or Salih if you want any follow-up on any of the things we've discussed. And also, if you are in the region, make sure you join both Fernando and Salih for those in-person events that I mentioned coming up later this month and early next month. So take care, everyone. We look forward to being in touch, and we'll see you next week. Take care.